Tax considerations are essential in evaluating different exit strategies for apartment investing. By understanding the tax implications, such as capital gains tax, depreciation recapture, and tax-deferred options like 1031 exchanges, small apartment investors can make informed decisions to minimize tax liability and maximize after-tax returns. Leveraging tax planning strategies and consulting with tax professionals helps investors navigate complex tax rules and optimize outcomes. Key tax considerations for exit strategies. Capital gains tax. Definition: capital gains tax applies to the profit from selling an investment property. If held for over a year, the gain is subject to long-term capital gains tax rates, which are lower than ordinary income tax rates. Impact: when selling a property outright, capital gains tax reduces the net proceeds. Planning to defer or minimize this tax enhances liquidity and retains more profit for reinvestment. Example: if an investor sells a property with a $200,000 gain, they would pay 15 to 20% in capital gains tax, depending on income level, potentially losing $30,000 to $40,000 to taxes. Depreciation recapture. Definition: depreciation recapture is a tax on the portion of gain attributed to prior depreciation deductions. It is taxed at a higher rate, up to 25%, when selling the property. Impact: since depreciation lowers taxable income during ownership, it results in a tax liability upon sale. Investors must account for this to avoid unexpected tax obligations. Example: if an investor has taken $50,000 in depreciation deductions over the years, they would owe up to 25%, which is $12,500, in depreciation recapture tax upon sale. So let's talk about tax-deferred exchanges, also known as the 1031 exchange. Essentially, a 1031 exchange allows investors to defer capital gains and depreciation recapture taxes by reinvesting proceeds from the sale into a new, like-kind property. This deferral maximizes available capital for the new investment, postponing tax payments until a future sale. For example, an investor can defer $40,000 in capital gains tax by using a 1031 exchange, reinvesting the full amount into a new property, which really enhances purchasing power. Now let's dive into some tax planning strategies to minimize tax liability. A 1031 exchange defers taxes on gains by reinvesting in a like-kind property within strict timelines, specifically 45 days for identification and 180 days for closing. This strategy maximizes reinvestment potential, enhances purchasing power, and can defer taxes indefinitely if repeated. For example, instead of paying $30,000 in capital gains tax, an investor defers it through a 1031 exchange, applying the full proceeds toward a larger property. Structuring the sale as an installment sale, where payment is received over time, allows investors to spread capital gains tax liability over multiple years. Investors can also defer and reduce capital gains tax by reinvesting gains into qualified opportunity zone properties, promoting long-term tax savings. For instance, an investor sells a property and reinvests the gain in an opportunity zone, deferring capital gains tax and reducing it if held for a specific period. Cost segregation identifies short-lived assets within the property, enabling faster depreciation. This can enhance deductions and lower taxable income during the holding period. This strategy reduces taxable income up front, improving cash flow and minimizing tax liability during ownership, making it an effective strategy before a sale. For example, an investor conducting a cost segregation study on an apartment property increases depreciation deductions, lowering taxable income by $20,000 annually. Using LLCs or partnerships may provide tax advantages by allocating depreciation and income in a tax-efficient way. For larger portfolios, converting to a REIT structure allows for dividend-based income and potential tax advantages in the long term. For instance, an investor with multiple properties structures them under an LLC, optimizing tax benefits and easing the process for future transactions or partner buyouts.